Assalamu alaikum. So today we are going to discuss second part of the money mistake series. In this video we will discuss what are the mistakes or what are the biases that people do while they process the information, and these biases also fall under the cognitive bias. So they are called information processing bias. So there are mainly four types of biases that fall under this information processing bias. These are the anchoring or adjustment bias, mental accounting bias, framing bias, availability bias. Let's discuss each of the biases differently. So anchoring or adjustment bias, this bias is very common in people, and most of the people suffer from these biases, like we anchor to a number or we anchor to an event, but the subsequent situations or present situation might not support our previously anchored number or anchored event. Then that's why we make mistakes. Say for example, if we think that the price of a stock was 300 taka, so and subsequently when we find that it is 275, we think that it is underpriced because once it was 300. That means we are anchored to 300. But the present analysis or present situation might not even support the price of 275. So that's why by basing on the anchors we make mistakes. And another example maybe, say for example, you want to buy something and you visit a first shop, and they ask you some a price, and you go to the second shop and they ask for slightly lower price. So as you are anchored to the first price, you seem the the second price is much cheaper, but think there might be that two prices higher. Even you might be getting even lower price in the third shop. So by anchoring to event, let's anchoring to event, what does it mean? Say for example, make investment in a boom season, your experience will be like that is making investment is a very profitable. But if you make investment in a very recession or bearish scenario, then your experience you might be anchored to the bearish scenario. So that's for therefore we have to be always analyze the situations in the present context or in the present scenario. And so what are the consequences of anchoring bias? There are some consequences, like sometimes when people suffer from the anchoring bias, they stick too closely to their original estimate, but their original estimate might not be right at this time. So may anchor to a economic state of a company or country. Say for example, if you anchor to a company when company was doing very good, but subsequently some other events or some other forecast might show that the company is going to do comparatively poor or worse in this present scenario or in the future, but you are anchored to a good time. So how we can overcome the anchoring bias? The first thing, we might ask ourselves a question that am I holding on to these stock based on the rational analysis? That means I need to ask myself, my holding or a stock, is it right in the current situations or in the future forecast? But that means my previous assumption, my previous forecast might not be right at this moment. Then we may ask ourselves second questions: am I trying to attain a price that I am anchored to? Say that what I previously said, that if you are anchored to a price, say for example the price of a stock was 200 and I anchored to the 200, and when it is 100 or 150, I always think that it will go up to the 200. But this time this might not go because the economic situations and financials strength and many things might change than it was previously. Then we might have past prices on market level might provide little or at future potential. That means past price level or market might help us a little to forecast the future. Then second bias is called mental accounting bias. This is very interesting bias. Under the mental accounting bias, we sometimes take decisions in a bucket. So say for example, when we have money, we ask say for example, we have money from our salaries, we have money from bonuses, we have money from uh, capital market, capital gain. So we do not weigh or evaluate the three sets of money equally. Sometimes uh, we become more conscious when we spend money from our salary, and we become very lavish when we spend money from our bonuses. Even we become more lavish and careless when we spend money which was earned from the capital gain of a investment stock market. But thing is that three sets of money or three amount volume amount of money are equal, and you can purchase same thing with the three sets of money. So so what is the problem of mental accounting is that sometimes based on our mental accounting we put different value on different sets of money. But thing is that we always think need to consider that money is fungible and money have the equal value uh, irrespective of its source. So we should the way or the cost with cost cautious we spend our money from salary, we should also exercise same kind of cautious or same kind of analysis to spend our money for which was earned from bonuses, also from our performance in the stock market. So this is the mental accounting. So people treat one sum of money differently from another equal size sum based on which mental account money is assigned to. So people code, categorize, evaluate economic outcomes by grouping assets into the number of non-fungible mental accounts. And sources of money are classified into different arbitrary groups: salary, bonus, inheritance, gambling, and planned use of the money such as leisure and necessities. So, what are the consequences of mental accounting bias? Mental accounting bias is the placement of investment into discrete buckets without ligature correlations. That means sometimes we make investment in a bucket. We do not correlate one set of money with another. Say for example, if we have the 3BO account, thus we might buy the same stock in the 3BO account. But in combined way, if we consider it as a single portfolio, we might not purchase that amount of some one stock. We might diversify. So we should consider our investment, consider our money in a single or uniform bucket, not a discrete bucket. And neglect opportunities to reduce risks by combining assets without low correlations. So this is another problem that we do not consider correlations with the one asset with another asset when we uh, consider them in a discrete way. And irrationally distinguish between returns derived from income and capital gain. When we get some income from dividend, we put more value on it, but when we get money from capital gains, we put less value on it. So how to overcome problems of money? Mental accounting, combining all our assets into one spreadsheet, another summary document. That means we should consider our full investment in the one way, one summary sheet and one portfolio, and integrating all sources of income. And we should integrate all our sources of income, and we should put equal value on all sources of our income, on our wealth. And lastly, and we have to diversify between the assets. The third bias is availability bias. So the availability bias is that if we want to estimate some probability of outcome based on, so we always do it how easily outcomes come to our mind. Say for example, if we forecast about a growth of a company, growth of a revenue or in EPS of a company, we might very easily think that 10% growth, 20% growth. So this is very available in our mind, but reality might be different from our available forecasting. So easily recalled outcomes are often perceived as being more likely than those that are harder to recall, understand. People often unconsciously assume that readily available thoughts, ideas, and images represent unbiased estimates of the statistical probabilities. And there are mainly four sources of biases: readability, categorization, narrow range of experience, and resonance. So availability bias is sometimes which is very easy to retrieve and categorize, and sometimes our narrow range of experience uh, support us to make this availability bias and resonance. So, what are the consequences of availability bias? Choose an investment based on the advertisement. So that means when I see advertisement, I get some information. So, and as advertisement is become very available on to me, I make decisions on the basis of advertisement. But I should seek opposite informations or negative informations also regarding the same stock or same investment, and limit investment opportunity set or fail to diversify. So having availability bias, sometimes we become more uh, prone to some stock, one or two more popular stock. We don't want to research on other stocks which might be more profitable and more sense making investments, which is very available and popular stock or the largest company, popular company. We confine our investment in that company. So fail to achieve optimal asset allocation. By this way, we sometimes fail to achieve optimal asset allocation. Say for example, if you have some money, we very have find very available is the doing some savings in the bank, because it is very easy and available. But if we search more information on the investment opportunities, we might get more return on other investment. So how to overcome this available bias? The first thing is that we need to develop an appropriate investment policy strategy. We should have a very appropriate policy, like what is my expected return, what is the my risk tolerance level, and what is the diversification. That means what percentage of my money I will invest in stock market, what is percentage of money I should will invest in money market, also government bond. These way I can overcome this availability bias. Second is the carefully research and analyze investment decision before making them. So I need to make research and analyze before making investment decision. And don't overreact to market condition, positive or negative. Sometimes we overreact to positive or negative information, but we should not be based our decisions on the information that is available. Rather, we should go further and dig deep or make more research to make better decisions. The final information processing bias is framing bias. So framing bias depends. It's like that. Sometimes we make decisions how is some situations or information is presented to us. If information is presented to us positively, we might take positive decisions. If it is represented to us negatively, we might take negative information. Say for example, if someone said that uh, uh, investing capital market is profitable in 80% of the cases, then we might think that it is profitable. But if the same information is repressed in this different way, say that in 20% cases making investment capital market is a loss making decision, then we might take different decision. So might happen to in other scenario also. So framing bias, what are the consequences of framing bias? The first thing is that willingness to accept risks can be influenced by how situations are presented or framed, that thus misidentify the risk tolerance. That means instead of basing on the fact, sometimes I base my decisions how information is presented to me, and choose the suboptimal investment even with the properly identified risk tolerance. That means sometimes I make suboptimal decisions because sometimes risk is exposed or becoming more prime to us, and focus on short-term price fluctuations which may result in excessive trading. Sometimes I have invested in the market and newspapers are uh, making the stories like that, and there is a fall in the stock market and incessant fall or continuously fall, and then I might think that okay, my market is going to fall more and more, and I get out of the market. So this is the framing bias. But same news would be differently framed after one or two increase or rise sessions. So how to overcome this framing bias? The first thing is that I have to ask myself, is the decision result of focusing on a net gain net loss positions? That means I have to adjust the both positive negative, and I have to take my decisions on net position is either net loss or net profit, not one side, total profit or total loss. So try to be neutral and open-minded as possible when interpreting any situation. So when interpreting any situation, either positive or negative, instead of becoming over enthusiastic or overreacting, I should be try to be neutral, and I should consider both pros and cons, negative positives, and take my decisions according to the net positions. I think that's all for information processing bias. In the next video, we shall discuss emotional biases, and stay with us till then. Thank you for